Okay, so the subject still capital market, and the topic for this video is still interest rates and their role in finance. This is already the third out of 5 videos on this topic, okay? So interest rate theories, we'll go over the different types of theories that we have concerning interest rates, okay? Specifically, determinants of the pure or risk-free interest rate. We have the following: classical theory or Fischer hypothesis. Second, loanable funds theory. Third, liquidity preference theory. And then last, we have rational expectations theory. So we'll discuss each one. Classical theory. So one of the oldest theories concerning the determination of the pure or risk-free interest rate, developed during the 18th and 19th centuries by a number of British economists, refined by Austrian economists Baumbauer, and elaborated by Irving Fisher early in the 20th century. So it is therefore alternatively referred to as the Fischer hypothesis. So this theory posits that the rate of interest is determined by two factors. So we have the supply of savings and then the demand for investment capital. Okay. This theory highlights the importance of households and businesses. Savings are generally carried on by individuals and families, the households. And for these households, they are simply abstinence from consumption spending. Okay, so we have the depositors or the investors. They have the excess money, and although there are wealthy investors, majority of bank depositors are ordinary people who are working as employees, and they only have very little savings actually. But with the number of clients or depositors in these banks, the aggregate amount is a lot of money. Okay, so there are people who would not spend all of their money, so they would be saving them and they put them in banks or financial institutions, and then these financial institutions would be lending them to businesses who would need funding or investment capital. Okay, so consumption spending means spending for both durable and non-durable goods and services. Okay. Savings are equal to income minus consumption expenditure. So you have your income minus your spending, then you have your savings. But of course, in personal finance, the equation is reversed. You have your savings equals you have your income minus your savings. You set aside your savings first, and then the rest would be your amount available to spend. Okay. Decisions on the timing and amount of savings are affected by several factors. These include the size of current and long-term income, the desired savings target, and the propensity to save. Or propensity to save, it includes the willingness to save and of course the capability to actually save. Okay? A lot of people, they want to save, but not everyone are able to go through with it because of several factors. Sometimes it's they get tempted to buy certain things, or things happen and they needed to spend it. All right. The higher the income, the higher the savings, because you have more money, and then it's not as if you can spend all of it. So you can probably save a higher amount compared to those who have little income. Okay. Households having more income tend to save more as compared with those with lower income. That's the expectation. While income determines the level of savings, interest rates also count. The higher the interest rates on deposits and other investment alternatives, the higher the tendency to save, right? Because, they would be encouraged to put their money into savings because the savings would give them a higher earning when the interest rates are high. And invest because households know that they will earn more in terms of interest earned. The classical theory assumes that individuals have a definite time preference for current over future consumption. Assumption is that a rational individual will always prefer current enjoyment of goods and services over future enjoyment. Although currently there's that concept of delayed gratification. Instead of enjoying the things now, you prefer to labor through a lot of things so that later you would enjoy the fruits of your labor. Okay, delayed gratification, but it's in contrast with this one, right? The assumption is, people like to enjoy all the things that they have now instead of later. So more like YOLO, you only live once, or FOMO, fear of missing out. So instead of savings, they spend their money to travel, to buy the latest gadgets, or to buy whatever they want that they think is, cool, and would give them praises from their peers or something. Anyway, therefore, the only way to encourage an individual or family to consume less and save more is to offer a higher rate of interest on current savings. That's only one, actually. Financial literacy, if we would only be able to educate a lot of people the importance of savings and investment, then it doesn't matter if the interest rate is high or not. They would still put some money into savings and investment. But of course, they would be encouraged to put more into that if the interest rates are higher. If more were saved in the current period at a higher rate of return, future consumption and future enjoyment would be increased. Okay? The interest earned on current savings will give households more to spend in the future. But of course, you have to take into account the inflation rate and the possibility that the interest rates would go down. In that case, the scenario would be reversed. Okay? This will drive the households to save now for the future. This is called substitution effect. This is called the substitution effect. That is substituting savings now for more consumption in the future. This gives way to the positive relationship between interest rates and volume of savings. When the interest rates go up, the volume of savings go up. More and more people save their money. Higher interest rates bring in a greater volume of current savings. Businesses also save in the form of investments in financial securities purchased from the financial market. They also grant loans because loans earn interest and are also a form of savings. Corporations retain their profits in the form of retained earnings, which they use for their current operating and capital expenditures. Okay? Ayan. So, yung mga businesses, kapag meron silang excess funds then and the interest rates are high, then they're also, in a way, they could also decide to lend their excess funds to others. And then, of course, earn interest from that. Okay? And yung mga earnings ng mga corporations, meron silang item or account na ang tawag ay retained earnings. Ito yung cumulative profits or losses over the years mula na magsimula silang i-establish up to the current year of operations. Tapos yung balance na tong retained earnings, yun yung pinakang limit nila on how much they can spend for their operating and capital expenditures. Okay, operating, edi yung normal na expenses nila to operate as a business. Pangbayad ng salaries and wages, pangbayad ng electricity, ng utilities, security, maybe, and the mga business permits and licenses, taxes, ganyan. Okay, or anything that they need in their operation or their production of goods and services. Tapos yung capital expenditures, edi kung gusto nilang mag-invest in property, plant, and equipment, machinery, transport vehicle, or office equipment, building, or another branch, land maybe. Okay, so yun. Ang limit nila, edi syempre yung balance ng retained earnings. The increase in retained earnings reported by corporations each year is a key measure of the volume of current business savings. These retained earnings also supply the funds that businesses use in investments, both short-term and long-term. Okay? Business savings determined by the profits of corporations and their dividend policies. Dividends are deductions from retained earnings. Di ba, kumikita yung businesses, but they have shareholders, yung mga may-ari sa kanila, mga bumibili ng kanilang shares. And normally, if they report a profit for a year, they would have to, declare dividends para naman matuwa sa kanila yung mga investors nila. Okay? And yung dividend, since distribution siya ng profit or earnings to the shareholders, so kabawasan siya sa retained earnings. Okay? However, the more critical factor is the amount of profits because most corporations try to keep their dividends at the minimum or increase them only slightly through the years. Okay? Normally, maliit lang naman talaga yung dividends kasi justify nila na hindi nila nilalakihan kasi yung retained earnings ay gagamitin for expansion, to improve the operations, or mag-expand or mag-invest in PPE, right? If profits are expected to rise, businesses will be able to draw more heavily on earnings retained in the firm and less heavily on the money and capital markets or funds. Okay, kung profitable naman kasi isang business and syempre yung collection din, cash flow ng kanilang from the operations, then pwedeng, they could rely on their own to fund their operations. Pero kung hindi, and in a way, medyo sablay, hindi masyadong profitable or merong kakaroon lang ng certain issues and hindi pa masyadong maayos ang collection ng receivables or from transactions. So they might have to, borrow funds from capital markets. Okay. The result is a decrease in the demand for credit and a tendency toward lower interest. So ito, supply and demand, diba? So kung yung mga businesses is maayos, profitable sila, and kaya nilang supportan yung sarili nila, they would not be enticed to borrow from the capital market or from financial institutions. And in that sense, dahil wala masyadong demand for the funding, then normally what would happen is that the interest rate would be lowered. Okay? Dahil mas mababa yung interest rate, so kapag nangutang sila, mababa lang yung babayaran nila na interest expense. So, sometimes, merong mga businesses na nai-entice doon. Kahit hindi nila kailangan pa masyado yung funds kasi kaya naman nila, they could, have additional plans for their operations kapag merong available na funding from the financial market or from the capital market because of low interest rates. Okay? On the other hand, when profits fall but firms do not reduce investment plans, so hindi masyadong profitable pero maliit lang yung profit, tapos marami silang, maraming investment plans, maraming balak bilhin or ipagawa sa kanilang businesses, so sila, they are forced to make heavier use of the financial markets for investment funds. So nangungutang, The demand for credit rises and interest rates may rise as well. Kasi tumaas yung demand, edi tataas din yung interest rate. Okay? Although profits are the basic determinant of savings by businesses, interest rates also play significant parts in business decisions to save. Higher rates in the money and capital markets encourage firms to use profits to support operating and capital expenditures. Kasi nga, pag mataas yung interest rate, mataas yung babayaran na interest expense. So, they might not be, encouraged to borrow funds. So, kung ano lang yung meron sila, yun lang yung gagamitin nila. So, in that sense, medyo magtitipid muna, hindi masyadong gagastos muna, alalay lang ng konti. Tingnan natin kung magkakasya yung internally generated funds nila. Okay? Conversely, lower interest rates encourage greater use of the financial markets for supporting operating and capital expenditures. Ayan. So, kung mababa nga yung interest rates, tapos meron silang mga plano for their operations, for improvements, ganyan. So, pwede naman silang mangutang, and to support those expenditures. Increased interest rates encourage businesses to invest in the financial markets because they earn more on these investments. The reverse is true when interest rates fall. Okay? So, in businesses naman, merong businesses na may excess funds, merong businesses na nangangailangan ng funding. Okay? When interest rates go up, etong mga businesses na merong excess funds, then, they are encouraged to lend money to others para kumita rin sila. Diba? Kasi mataas naman yung interest rates na pwede nilang i-charge. Right? Tapos, on the part naman itong mga businesses na kapos sa funding, kapag mataas ang interest, edi hindi sila masyadong, na-encourage na mangutang kasi nga mataas yung interest rate. Right? Governments also save, although less frequently than households and businesses. Governments only save when receipts exceed current consumption. So, di ba ang government the bulk of its revenue comes from taxes, right? Pero yung pagbabayad ng taxes, hindi siya isang bulto, for the year, nakaschedule siya depending on, kung magkano ang, di ba meron tayong monthly tax returns, quarterly tax returns, and then we have the annual tax returns, So, yung collection ng government of these taxes, nakaspread siya over 1 year. So, minsan may mga tawag dito, certain periods na mataas yung kanilang spending, may mga periods din na kinokontrol nila yung spending para sumapat din sa kanilang collection. And they can only save kapag yung receipts nila, yung natatanggap nila na pera is mas malaki compared dun sa kanilang ginagasto. Syempre naman, ano. Government savings are therefore only incidental and interest rates may not be a big factor. However, the government uses interest rates as a tool of monetary and at times fiscal policy. Okay? So yung government spending normally hindi siya ganun ka-affected ng interest rate unless gagamitin siya as a form of, as a tool in fiscal policy to to control the amount of monetary supply in the market. So, dun lang probably affected yung government spending. Pero, normally, government spending hindi siya affected by the increase or decrease in interest rates. Okay? Unless gagamitin siya in consonance with the monetary policy. Okay? Classical economists believe that that interest rates in the financial markets are determined by the interplay of the supply of savings and the demand for investment. Okay? Supply of savings, yung mga tao na nagsisave ng kanilang pera sa mga financial institutions or the capital market. And then yung demand for investment, ito mga businesses na nangangailangan ng funding for their operations or probably expansion. Specifically, the equilibrium rate of interest is determined at the point where the quantity of savings, alin ang quantity of savings? This one. Quantity of savings supplied to the market is exactly equal to the quantity of funds demanded for the investment. So, ito naman yung quantity of funds demanded for investment. So, ayan. Ang equilibrium, edi kung saan sila nag-meet. Itong part na to. Alright? So, have your volume of savings, ito, and then you have this demand for investment. Ito yung equilibrium nila. And this is the interest rate. Alright? At point E, where the supply of savings line and the demand for investment line intersect, is the equilibrium rate of interest and the volume or quantity of capital funds traded in the financial markets. For example, if the total volume of savings supplied by households, businesses, and government in the economy at an interest rate of 10 is 100 billion, this same 10% interest would be what businesses would require or demand for investment purposes. Therefore, 10% would be the equilibrium rate of interest, and the 100 billion is the equilibrium quantity of funds that would be traded in the money and capital markets. Okay? Yung market rate of interest moves toward equilibrium level. Okay? Nag-adjust naman siya depending on, let's say, merong additional demand ba for investment, may additional volume ba of savings, so mag-adjust din yung equilibrium. However, supply and demand force change so fast that the interest rate rarely has an opportunity to settle in at a specific equilibrium level. So, minsan kasi, di ba, how do you monitor yung pasa-pasa ng pera in the market? Paano mo mamomonitor yung change in the supply and the demand? Okay? So, minsan, masyado siyang mabilis mangyari, hindi agad na i-adjust yung interest rate. Pero, on the part naman ng BSP or the Monetary Board, they have ways to do that, and sometimes probably a bit of, use of estimates sometimes, but reliable naman, okay? At any given time, the rate is probably above or below its true equilibrium level, but moving toward that equilibrium, okay? Meron din time to adjust, kumbaga. If the market rate is temporarily above equilibrium, the volume of savings exceeds the demand for investment capital. Okay? Nasa taas kasi ng equilibrium. So, bandang dito yon. So, mas mataas yung volume of savings compared to the demand. Asa na tayo? Creating an excess supply of savings. Savers will therefore offer their funds at lower and lower rates until the market interest rate approaches equilibrium. Similarly, if the market rate temporarily lies below the equilibrium, investment demand exceeds the quantity of savings available. So, yung business firms will bid up the interest rate, kasi mas malaki yung demand kesa sa supply. So, tataas yung interest rate until it approaches the level at which the quantity saved equals the quantity of funds demanded for investment purposes, or yung equilibrium nga. Classical theory sheds considerable light on the factors affecting interest rates, but it has limitations. So yung theory na to, classical theory or Fischer Hypothesis, this ignores factors other than savings and investment that affect interest rates. Financial institutions create money by making loans to the public. Credit is money. The volume of money created or destroyed affects the total amount of credit available in the financial system and is therefore a factor in determining interest rates. Another limitation of the classical theory is its assumption that interest rates are principal determinant of the quantity of savings available. Today, income is more important in determining the volume of savings. The higher the income, the higher the savings is the general rule. Okay. Lastly, this theory believes that the demand for borrowed funds comes principally from the business sector. Although, yes, pero if you consider na yung mga small amount borrowers, madami naman kasi sila. So, yung aggregate amount niya is significant volume din, significant amount din. Ano? Today, however, both consumers and governments are important borrowers, significantly affecting credit availability and cost. These limitations are addressed by more recent theories that will be discussed in the following sections. So, yung second theory natin, we have the loanable funds theory. Okay? Often used for forecasting interest rates, based on the premise that the interest rate is the price paid for the right to borrow or use loanable funds. Okay? Therefore, borrowers create the demand for loanable funds and the lenders on the other side of the market seek to provide loanable funds needed by the borrowers. Okay? So, kumbaga yung demand side. Households, businesses, and governments participate in both sides of the market. They are all both borrowers and lenders at one time or another. Okay? Kapag meron silang excess na money, so they could probably lend, pero pag sila naman yung nangangailangan ng pera, they're the ones who would borrow. Okay? Households invest whatever savings they have from their incomes. They also borrow when their incomes are insufficient to support their needs, especially for unforeseen events such as death or calamities, mga contingencies or emergencies. They borrow for housing needs, educational needs, funeral needs, hospital needs, and the like. They also deposit money in the bank and invest in other financial instruments that they can afford. Okay? Businesses are active participants in the financial markets, borrowing from the market for inventories, working capital needs, purchase of property, plant or equipment, and other projects by issuing stocks and bonds. Okay, so my corporations, one way that they can borrow from the capital market, hindi lang by borrowing from financial institutions, they can also issue stocks and bonds, so that they could increase their capital. They also act as surplus units when they purchase securities from the financial markets. Governments naman, they borrow from financial markets by issuing government securities like T-bills, T-notes, and T-bonds. We have government bonds or treasury bills when they have deficits. Okay? But the government also buys financial securities from the financial markets whenever they have surplus funds. Alright? Ganun naman normally yung situation. Pag may excess kang pera, edi pautang mo. Kapag ikaw naman yung nangangailangan ng pera, edi mangutang ka. Foreign lenders and foreign borrowers also exist. IMF, International Monetary Fund, is a great provider of loanable funds. Foreign businesses buy and engage in the financial markets too. Okay, meron naman tayo mga foreign investors din. That could provide funding for our local businesses. So the figure for the equilibrium interest in loanable funds theory is almost the same as the figure in classical theory. So you have your supply, you have your demand, and then you have your equilibrium, which provides the interest rate, okay, and then the quantity of the funds. So it's the intersection where the supply for funds and the demand for funds intersect, okay. Also based on the assumption that higher interest rates, fraud households, okay, entice households and savers to defer expenditures so that the earnings and their current savings will afford them more funds for future expenditures. So almost the same, right? The demand curve is downward sloping, while the supply curve is upward sloping. This is because the decrease in interest rates stimulates expenditures on items financed through borrowings like purchase of appliances, new homes, and investments in plant and equipment. On the other hand, savers increase supply of funds when interest rates are high because they will earn more when they supply the funds. Okay? So again, kapag yung interest rate ay bumaba, so yung mga mangungutang tataas, yung dumadami yung mga gustong mangutang kasi bumaba nga ang interest rate. And then on the part naman ng mga may excess funds, edi sa halip na gastusin nila yung pera nila, i-save na lang nila para pautang sa iba para magkaroon sila ng earnings from that. Okay? For the economy to be in equilibrium, planned savings and planned investments must be equal across the whole economic system. If planned investment is more than the planned savings at the equilibrium rate, so planned investment demand, okay, is greater than the supply, so tataas, push interest rates higher in the short term. However, as additional investment spending occurs, income will rise, generating a greater volume of savings. Eventually, interest rates will fall in that case. Similarly, if the exchange rates between dollars, yen, and other world currencies are not in equilibrium with each other, there will be further opportunities for profit available to foreign and domestic lenders by moving loanable funds from one country to another. So, minsan nga yung economic situation ng isang country, its economic growth or, development would affect the amount of foreign investors. And foreign investors do provide, funding, could provide funding for local businesses. Okay? Only when the economy, the money market, the loanable funds market, and foreign currency markets are simultaneously in equilibrium will interest rates remain stable. But in reality, kind of hard to achieve. Thus, a stable equilibrium interest rate will be characterized by the following. Una, planned saving equals the planned investment across the whole economic system. Money supply equals the money demand. So essentially, yung supply and demand is, equal. Quantity of loanable funds supplied is equal to the quantity of loanable funds demanded. And then the difference between foreign demand for loanable funds and the volume of loanable funds supplied by foreigners to the domestic economy is equal to the difference between the current exports from and imports into the domestic economy. So, equilibrium on the balance of payments and foreign currency market. Okay? The figures below depict the effects of increased supply of loanable funds with demand and change and effects of increased demand for loanable funds with supply and change. Okay? So, itong una, yung supply ay nag-increase, right? Kapag nag-increase yung supply, the interest rate would go down. Tapos, tawag dito, the volume of loanable funds would go up. Okay? Wait, kasi nga, nagkaroon ng increase in the supply, right? So, yung demand would go down. Wait, it would have to increase as well. Okay? Tapos itong kabila, you have your supply, tapos yung demand naman niya ay tumaas ba? Bumaba? Which is D1. Okay, is this the D1? Okay. Tumaas yung demand niya. Okay? So, kapag tumaas yung demand, tataas din yung interest rate. Okay? Tapos, since tumaas yung interest rate, normally, yung supplied funds would increase as well. Okay? So, ayun. Shows that the supply schedule slides downward to the right when supply increases, resulting in a decline in the equilibrium rate of interest. Pag tumataas yung supply, tapos yung demand hindi naman nagbago, so di ba nagkakaroon ng excess supply, so yung interest rate is bababa talaga. From I1 to I2 with demand and change. The quantity of loanable funds traded in the financial system increases from C1 to C2. Okay? Kasi nga ang nangyari is increase in supply. Itong kasunod, yung 26B, the volume of credit extended increases from C1 to C2 when the demand for loanable funds increases. Okay? From DLF to D2LF with no change in the total supply of funds available, but at higher interest rates. Okay? Normal na ganito rin yung situation ng, normal demand and supply for goods and services. Sa supply, kapag increase, edi sa right side yung line. Okay? Kapag decrease, dito sa left side. Kapag naman demand, ayan, right side din ang increase, ang decrease, edi dito sa left side niya. Right? This theory provides a broader perspective in the movement of interest rate. Okay? Yung ikatlo, Liquidity Preference Theory. In 1930, John Maynard Keynes introduced the concept of money demand and used the term liquidity preference for money demand. This is the reason this theory is called liquidity preference theory. Stipulates that the interest rate is determined in the money market by the money demand and the money supply. Interest rate is the point where the money demand is equal the money supply. In a graph like the one in the figure 27, intersection point ng demand and supply schedule. If we denote money demand as D and money supply as S, interest rate would be when, demand is equal to the supply. This is equilibrium, okay? At D equals S, interest rate and quantity of money are in equilibrium. That is equilibrium point in the money market. When the quantity of loanable funds decreases to Q1, okay, punta dito, wait, where's the Q1? Ito nga. Bumaba yung supply. So, the demand increases kasi pag bumaba ang supply, nagkakaroon ng, tumataas ang demand for goods and services. Pero in this case, edi tumataas yung interest rate. Tumataas siya from, i.e. from the equilibrium interest to I1. Tapos yung quantity, if the quantity of money supply increases to Q1, increases to Q2, dito naman, tumaas siya, Q2. Wait. If the quantity of money increases, ang money ay itong supply, to Q2, so ito, from equilibrium here to this point, B, ang quantity is at Q2, the demand decreases, and interest rate goes higher to IH. Okay, ito yung interest rate niya. Line AB, itong point na to, line AB, denoted by ESM, represents the excess supply of money when interest rates go high. Okay, and alam naman natin, kapag tumataas ang interest rates, yung demand bumababa. Okay. Actually, tawag dito, papaikot-ikot lang. Kapag tumaas yung supply, bababa ang interest rates. Kapag bumaba ang interest rate, tataas ang demand. Kapag tumaas ang demand, ano mangyayari? Tataas din yung interest rate. Kapag mataas ang interest rate, bababa ang, bababa ulit yung demand. So, gano'n lang. Ulit-ulit lang hanggang sa bumalik sila sa equilibrium point. Okay? Line CD, denoted by EDM, represents the excess demand for money when interest rates decrease. Okay? From the foregoing discussion and remembering the relationship of velocity of money to the demand for money, which is inverse, we can come up with figure 28 to show the interrelationship between interest rate, money demand for money, velocity of money, and supply of money. So from the figure, we will note that the relationship between interest rate, supply of money, and velocity of money are in the same direction. So kapag tumaas yung interest rate, diba, dadami yung supply ng money kasi dadami yung tao na gustong mag-save kasi mas mataas yung interest rate na kikitain nila. Tapos since mataas yung supply of money, normally, supply of money in the market, right? Pero yung demand for money is bababa kasi sa halip na hawakan nila yung pera is ilalagay nga nila or gagastusin nila yung pera. Okay? Tapos yung velocity of money, since dumami yung supply of money in the market, so mas iikot siya na mas mabilis sa market. Okay? Tapos yung inverse situation, edi pag bumaba yung interest rate, bababa din yung supply of money, bababa din or babagal yung velocity of money, tapos tataas naman yung demand for money. Okay? So, ayun. The liquidity preference theory gives insights on how an investor behaves and how the government uses interest rate as a monetary tool. Investors purchase securities when interest rates are high for the simple reason of yields. Okay? Mas malaking kikitain nila. Increasing the supply of funds in the financial system. They shy away from buying securities when interest rates are low kasi, mababa lang, thereby reducing the supply of money in the financial system. Similarly, the government can regulate the money supply, ensuring that it grows more slowly than money demand to bring about higher interest rates. Contracting money supply when there is plenty of it in the financial system ensures higher interest rates. So, pinapababa yung supply ng money. Okay, in that sense, pag mas mataas kasi yung demand compared to the supply, then the interest rates would go up. In contrast, if the government expands money supply when there is low supply, interest rates go down. Okay, in nagdagdag ng money supply, tumaas ang supply, pero yung demand naman is hindi nagbago, so in that case, bababa ang interest rates. Okay. Like the other theories, this theory also has its limitation. It is a short-term approach to interest rate determination, modified because it assumes that income remains stable. In the longer term, the interest rates are affected by changes in the level of income and inflationary expectations. It considers only the supply and demand for the stock of money, whereas business, consumer, and government demands for credit clearly have an impact on the cost of credit. There is a need for a more comprehensive theory giving consideration to the roles of all participants in the financial system. Okay, last one for the theories, we have rational expectations theory. This came about in the advent of the information age. It is based on the premise that the financial markets are highly efficient institutions in digesting new information affecting interest rates and security prices. When new information appears about investment, saving, or money supply, investors immediately translate this information into investment or borrowing decisions. So yung interest rates and security prices would fluctuate rapidly as new information appears. Okay, di ba yung isa kanina, medyo it would take time before the interest rate is adjusted. Pero dito, because mabilis na kasi ngayon yung pag-transfer, di ba, ng information and yung in making information available to more users. So, mas mabilis yung nagiging adjustment to any changes in the market. Thomas stated, in the rational expectations world, people are assumed to behave as if they were tuned into the state-of-the-art model of inflation. Thus, as new information on key determinants of inflation becomes available, they quickly plug it into their inflation model and revise their outlook accordingly. Okay. In contrast to adaptive expectations, which is backward-looking, relying on past data or experience, rational expectations introduced by Lucas in 1973 is forward-looking and uses all available information in forming expectations. Before, it is true, diba, that you can base your decisions on historical data. But given how fast technology is advancing and the different scenarios that are now available because of, businesses could innovate a lot. They could introduce new products and services, and they could use new medium in delivering their goods and services. So, you can't exactly compare the current situation with the past situation. So, basing it on past data is not that, not that reasonable, right? So, rational expectations, they believe that with the availability of new information, then the decision should be based on those new data, okay? This means that households and firms are forward-looking. Households, especially workers, rely on wage flexibility and labor market clearance, as well as rational expectations. However, Lucas admits that the information may be imperfect or incomplete. His upward sloping supply curve, known as the Lucas supply curve, shows the disparity between the true price level and the perceived or expected price level, considering the assumption of imperfect information. Especially if the information came from, private companies. Normally, di ba, meron sa mga inside information that they don't provide to the public, but sometimes it would get out. But what would get out are not complete data, pwedeng, just a partial information, and the rest of it could possibly affect the decision negatively. So, ayun. It could be imperfect and incomplete. When the disparity disappears, the aggregate supply curve becomes vertical. Lucas has studied workers' expectations, therefore using the labor market and wages. Okay, so Rose explained the theory. The rational expectations theory views that forecasting interest rates requires knowledge of the public's current set of expectations. If new information is sufficient to alter those expectations, interest rates must change. If correct, this portion of the rational expectations theory creates significant problems for government policymakers because people would have already responded a certain way before the changes have been implemented. Okay, it implies that policymakers cannot cause interest rates to move in any particular direction without knowing the public already expects to happen and without knowing the public already expects to happen and indeed cannot change interest rates at all unless government officials can convince the public that a new set of expectations is warranted. Okay? Di ba currently, kaya mo naman with, availability of information nga, maraming tao, even ordinary individuals, or probably experts in the field of finance, they could already, watch the market and make their own analysis of what's happening and what the government is probably going to do in response to, the changes and the current market situation. And with those expectations analysis, with their expectations or projections, then they could, provide advice on what to do. And they themselves, if they are investors, then they would already have done something that would benefit them in the long term with that available information. Okay. And then, of course, since they have analyzed the data and they have the information, if the government did not, if the government did not act according to their expectation, they would have to ask why. Okay, why is it that you did this instead of that? What's your justification for that? Okay, it would be questionable move if if something like that happens. So the government, if they do that, they would really have to justify themselves and maybe provide more information that's not available to the public, which, would cause their analysis to be not correct because, again, the possibility of incomplete or imperfect information. Okay. Where are we? Moreover, because guessing what the public's expectations are treacherous at best, rational expectations theory suggests that rate hedging using various tools such as financial futures contracts to reduce the risk of loss from changing interest rates is preferable to rate forecasting. Okay, so because businesses especially, and if they are involved with large amounts of money in investing or a certain transaction, then they would have to, if they feel that it's going to be risky, then they would have to hedge their transaction. Okay, use of hedging. But only if they expect it to be, what do you call that? To affect them inversely. That's why they need the hedging to protect them from those risks. Okay. Figure 29 shows that the expected price level is fixed along the curve. Okay, this is the curve, supply. When the actual price level equals the expected price level, output is at the natural level y. So this one. Output rises above the natural level when the actual price level is greater than the expected price level. Which is the expected price level? This one. Okay, output falls below the natural level when the actual price level is less than the expected price level. So it goes down from here to here. Okay. Like the other theories, this theory also has limitations. All of them do. It does not, for one, according to Bouillard and Rose, provide convincing proof when empirical tests of the theory are done. Because of its limitation, the information could be incomplete or, what's the other one? incomplete or imperfect. Okay, so those could lead to wrong decisions, right? Provide convincing proof when empirical tests of jury are done. This is due to that we do not know very much about how the public forms its expectations. Okay, maybe the experts, they have their own expectations, but the general public who are not very knowledgeable with what's actually going on in the economy, they could in a way react in a different way. Their expectations would be very different than those who are properly informed as well, or who understands what's going on in the economy. Okay. That is, what data is used, what weights are applied to individual data, and how fast people learn from their forecasting mistakes. Because not everyone does. Okay, some people just go with the flow. If they hear something, they just do what they think is correct. Sometimes they would be doubtful and do the opposite. You can't predict what they are going to do. In addition, real-world markets seem at odds with the assumptions of the jury. For example, the cost of gathering data and analyzing the same are not always negligible. It could be very costly and should be taken into consideration when making decisions relative to investment. Also, interest rates on short-term securities are significantly correlated with past interest rate movements. Okay, so in a way, historical data still plays a role, right? There are still a lot of studies and research. Therefore, not all interest rates display the kind of behavior implied under the theory. There are still a lot of studies and research needed to be able to closely predict interest rate movements and avoid forecasting errors. Okay, because it would really, it would involve a lot of research for you to have all the information that you need to make the best decisions. Figure 30 depicts a shift of the Lucas supply curve, showing that when the expected price level rises, the AS curve shifts off and to the left. Wait, let's see that first. Figure 30, shift of the Lucas supply curve. What did it say again? When the expected price level rises, so from B to C, the AS curve shifts up and to the left. AS curve shifts up and to the left. Wait, this is to the left, so from here to here. Okay. At price level P, what's that? Output will fall from Y1 to Y2. From Yn to Y2. Okay, output will fall from here to here. And then on the contrary, firms will be willing to supply the output Y only if the price level rises from P1 to P2. Okay, so here. Okay. Price level output will fall from Yn to Y2. Right, supply will decrease. On the contrary, firms will be willing to supply the output only if the interest rates are high. Okay. When it comes to people who would like to, invest their money so that they would earn more, then they want the interest rates to be higher. Okay, but if it lowers, then the tendency is the supply would also go lower because, people would not want to do that, would not want to make their money available for lending if they're not going to earn that much anyway. Okay, so that would be the end for this video. The next one, the 4th out of 5 about interest rates and their role in finance, would be about determinants of interest rates. Okay, so this would be it for this one. Thanks and bye.